Good afternoon and welcome to the Advanced Asset Management Advisors Quarterly Market Commentary Review. I'm Bob Baker, President of Advanced Asset Management, and joining me today is Phil Voelker, my business partner, friend, and AAMA's Chief Investment Officer. Hey, Phil, how are you?
Good. How are you doing?
Good. Happy New Year.
Thank you.
Hard to believe another year has rolled by.
Absolutely.
Before we get into the commentary, I wanted to take a couple moments to review who AAMA is. We're an independent investment advisor, and our work is fundamentally rooted. We seek to add value by tilting portfolios towards attractive market segments through our market pricing and sector valuation investment discipline. Our highly experienced investment team, with over 30 years of average experience, spends a lot of time and effort in evaluating the stock and bond markets. We believe we deliver a team approach which allows advisors to speak directly with me and Phil. We provide an investment process that's easy to understand, track, and most importantly, discuss with clients. When we look at the last 2 years in the securities markets, we can label that period as tumultuous. Stocks and bonds experienced extreme price swings. And those price swings, coupled with Federal Reserve policy, drove the markets to rapidly changing perceptions of values, risk, and economic prospects. The CPI rose almost 9%, while the average hourly earnings only rose about 8%. And that's left consumers behind the eight ball in meeting their higher living expenses. In the last 2 years in the securities markets, we've seen returns that have been very volatile. If you look at T-bills over the last 2 years, they're up about 6%. The equal weighted S&P 500 index is up 0.5%. The long-term aggregate bond index is down 8%, and long-term treasuries are down 29%. But the Magnificent Seven stocks were up 14%. And those stocks include Apple, Microsoft, Google or Alphabet, Amazon, Nvidia, Meta Platforms or Facebook, and Tesla. And we think of those seven stocks, it reminds us of the movie The Magnificent Seven. It's hard to believe I'm older than the movie is, but anyways. What we learn from this is actors rise and fall over time, and the same is true for companies. None are invincible, no matter how important or persuasive they are and may seem today. Now, Phil, could you take a couple minutes and kind of summarize the economy for us?
Sure. And this summary is available on our website at the Economic Insight section. We update it continuously when things change. And the economy has been stronger than most people have expected. The typical projection for 1 year ago was that we would see a recession starting by mid-year. We've been contrary in our opinion, meaning we did not expect a recession last year. And there's several reasons for that. First of all, just a brief update, consumption remains relatively high. Investment in the economy, government spending, net exports, the trends there are fairly stable. You might think that government spending is starting to weaken a little bit because some of the big spending bills are behind us. But the factors that kept us positive on the economy all through last year were the fact that we had a tight labor market and still do. We had stimulative government spending, and there's still excess liquidity in the system left over from 13 years of easy monetary policy. So today, we're still of the same opinion, maybe not quite as strong as a year ago, but the economy appears to be pretty resilient. to us.
And so, Phil, basically our core position remains unchanged.
That's true. And, a lot of the volatility, Bob, that you referred to, the Magnificent Seven having a 45% decline to rebound to a 14% gain over the 2-year period. A lot of that volatility has been driven by the Federal Reserve changing interest rate policy, and more importantly, the market's perception of what the Federal Reserve is doing or might be doing. There's been probably 6 times in the last 2 years where the markets have anticipated changes in Federal Reserve policy only to be disappointed. And today we're in the same position, whereas just 3 weeks ago now, the Fed's policy meeting and press conference afterwards, basically the Fed said that they're still in the same place. They're on hold. They're not talking about when to cut rates, but some of the members who post projections, called the SEP, penciled in 3 rate cuts for next year. So the market went ahead and penciled in 6 rate cuts. That helped the markets rally into year end. So there's a little bit of an edge coming off of the hawkishness of the Fed, but we have to probably call it neutral at this point. And as even they have said, their inflation fight is not over yet. We think that if they continue steadfast in monetary tightening, that in order to meet the 2% inflation target, there will probably be significant damage to the economy and the markets.
And their rosy commentary from 3 weeks ago kind of did an about face when we got the Fed minutes yesterday, correct?
That's correct. There's nothing in there that suggests that they were discussing cutting rates, and certainly not when.
And I think it even implied that they were going to have to raise rates a little more.
Well, they left that possibility on the table for sure.
Right.
So anyway, the market has gotten a whiff of easing, maybe a little bit reduced rhetoric from the Fed. But if we take a step back and look at long-term real yields, and let's just assume for a second that the Fed sort of soft pedals a little bit on inflation, and inflation runs 2.5 to 3 instead of meeting their 2% target. And you just add normal inflation premiums to those rates, and you'll find that the 10-year really should be closer to 5%, and the T-bill rate should be down more to 3.5. So if those things were to develop, then the negative yield curve would go away. We'd be back in a more normal, positively sloped yield curve, which would give anybody the ability to more actively manage duration risk within portfolios. So this is not necessarily a forecast, but just laying out the potential scenario, assuming a modest economic growth of say 2% and inflation of 2.5 to 3. That's where rates should be.
Absolutely. Now let's shift gears for a moment and talk about corporate earnings and stock valuations and where they are today.
Yeah, sort of like the stock market, corporate earnings declined in 2022 and then rebounded last year and have recovered the decline. But the dramatic increase in equity prices over the last 3 months has built current PE ratio to 22.5, which is higher than 80% of the historical observations in our database. And the forward PE is 20. So the market is overvalued from a PE measurement. Earnings are expected to grow next year, although those projections always get revised. They always seem to be a little bit optimistic and typically come down a little bit over the course of the year. But the bottom line is the market's overvalued. That doesn't mean we're automatically going to see a decline in prices. What it tells us is that the risk in the market is higher should there be negative surprises, be it declining economic situation or geopolitical issues, whatever it may be, that call it a black swan, the market's more vulnerable than it would be if it was priced cheaper.
Absolutely. And of course, we have to circle back to the geopolitical landscape and some of the gyrations that are happening around the world. Can you take a minute and kind of summarize these?
Yeah, we usually don't talk a lot about this, but we do track it, of course. It's important to remember that in an election year, the Federal Reserve tends to avoid dramatic changes in policy or negative policy changes. That's one thing that sort of supports a little bit more dovish positioning by the Fed. So maybe we get a rate cut before June, but typically after June, they stay out of the market unless there's some emergency of some kind. So that supports a stable to slightly dovish Fed position. The Ukraine situation has sort of fallen from the headlines because of the Middle East, but it appears that there's a stalemate in Ukraine. There'll probably be a peaceful, quote unquote, peaceful settlement. And it, the whole situation is a reminder that sanctions tend to be counterproductive, where, 2 years ago, Russia sold 90% of the petroleum to Europe. Now it's being sold to China and India. I think one of the important things to keep track of, because this was an unprecedented sanction, and that's 630 billion of Russian central bank reserves are currently under sanction. Just under half of that's actually been impounded, and the balance has sanctions that slow its movement. That's going to be, I think, a important development. China, Taiwan, the headlines tend to be sensational, but we have to remember that the U.S. policy is based upon the Taiwan Agreement and the Relations Act, which says basically we recognize one China with Beijing in charge. And as long as that is accomplished under peaceful means, then it's U.S. policy to go along with it. So China's recent rhetoric of a peaceful reunification doesn't seem to be inconsistent with our policy. The hot news currently, of course, is the Middle East. It's always been a powder keg. It's heated up. One thing that stood out to us is that we do have 30 military installations in a concentrated area, and of course, significant naval assets over there as well. The one thing that is starting to affect the market a little bit is shipping rates are going up because many of the private companies are avoiding the Suez Canal, which adds shipping costs by going around the Africa continent. So far, oil markets have not been negatively impacted, at least not significantly, but there's always the potential for black swan coming in oil prices if some of the shipping lanes were disrupted permanently or semi-permanently in choke points like the Strait of Hormuz. So it's important to keep these factors in mind just as potential negative impacts because, in particular, we're in a overvalued market.
And because of that overvaluation, summarize how we're approaching the equity and the fixed income market.
Yeah, the equity portfolios are still focused on large cap with a tilt towards defensive sectors. I think the key thing right now is to focus on earnings and balance sheet quality. We've been positioned this way for several years as the market developed an overvalued position several years ago. And with the volatility we've seen and the valuation levels we see, it's important to have a little bit more defensive tilt in the portfolio and certainly quality. In the fixed income portfolios, again, we've been in short maturities and high quality for quite some time, which enabled us to navigate the increase in interest rates very well on a comparative basis with, the long-term treasuries being down 30% still over the last 2 years. So short maturities have held up well. We're not sure that the whole interest rate environment is resolved yet. The Fed is still holding tight, and the bond market, meaning the longer maturities, have been very volatile, swing from significant gains and losses on a monthly and quarterly basis as the Fed, or the perception of what the Fed might be doing, changes. So, our mention of the Fed, perception of what the Fed's doing, has woven itself into this whole conversation and has affected both stock and bond market valuations pretty dramatically.
That kind of summarizes our market commentary. We encourage you to download a copy of it or read it on our website. And of course, please don't hesitate to contact us. My contact information is listed along with Aaron Plaskal's, our national sales manager. And if you have any questions about our views and thoughts on the markets, please contact us. Or if you have any questions on any of the portfolios that could be used to help you, help your clients to achieve their intermediate and long-term investment goals and objectives. Until next quarter, thanks, Phil.
Thank you.